Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yeah, glad you're with us as we talk about financial matters. Got a good program. Got a couple good calls. Going to talk with Mark Schoen, one of our advisors, about how he was taking advantage of some client. I'm joking.
Mark Schoen, if you could meet this guy in person, he is more like he just radiates energy.
He's a great advisor. He's not taking advantage of anybody.
I always used to say that if you called me and said, well, the weirdest thing happened, we were in a meeting and Mark Schoen spontaneously combusted, I'd say, oh, yeah.
Anyway, so we'll have Mark later on. And
makes sense.
So we're going to have a good time.
Yeah.
And as we kick things off, I'm going to talk about the importance of having the right person listed as trustee of your estate. We're not attorneys, so I don't personally draft documents. We work with attorneys. But being a financial advisor of over 3 decades, we have seen it all. I've got a neighbor who's an attorney. He's an attorney that specializes in estate litigation.
Suing trustees.
Families suing one another. Family members suing. That's his career. It's a specialty of suing. And you think, why would anyone do that? Like, why would you sue your siblings?
Oh, I've seen it.
I know, we've both seen it.
Actually, we've got one right now. But fortunately, in this situation, the client had named a family member as a trustee and a professional trustee.
As a backup or as a co?
As a backup. And I am strongly encouraging the family member to step down and allow the professional trustee to take over because of the disharmony in the family.
Well, I was dealing with a situation in the last couple of weeks. Mom and dad pass. There's $20 million or so. 3 siblings, right? 3 children to be split up equally amongst the kids,
and that's a big amount of money.
Oh yeah,
it's a big amount of money.
Yeah, and the person I was talking to, they didn't have much in the way of assets. They were still paying down their mortgage, and so they knew mom and dad had assets and had been ill for a number of years, and they passed on. And this is about 2 years now that they've both been passed on.
Okay.
And one of the brothers is the trustee. And the brother, so it's been a couple of years. They had received nothing until recently.
After 23 months?
Something like that.
20 months.
And he says, well, they had to take care of some taxes.
Okay.
And they have to get some things in order.
Okay.
But there's some brokerage account. The estate has brokerage accounts and some commercial properties. And the one brother who's the trustee, he keeps saying, well, we need to get these things squared away before I can distribute anything. And then he distributes, had some family gathering, and he had envelopes with them and passed them out like he was the...
oh, that's hard to watch. Like it was his money.
Right. Hey, good news. And come on down here. Let me hand you this envelope and he distributed about $100,000 or so.
Out of a $20 million.
Correct. $100,000. And as it turned out, the $100,000 is going to be taxable in the previous tax year. They're going to get a K-1 on this portion of it. And my colleague says, well, it would have been nice to know I could have done some other planning last year had I known I was going to have a $100,000 taxable distribution. And the brother's like, well, that's too bad.
Just pick the wrong trustee. Parents.
The trustee's an attorney? And I said, you need to have a conversation with him that his fiduciary responsibility lies with the beneficiaries of the trust.
That's correct. That is exactly when I talked about the person that I asked them to please give it up to the professional trustee. I talked about her fiduciary responsibility. And I said, this is a big
legal responsibility.
Big responsibility. You cannot put your interest above that of the beneficiaries, or even the perception that you've put your interest above that of the beneficiaries can create litigation.
Now, my colleague's not going to be suing his brother. They're close.
They are close.
But it's creating...
Yeah, especially...
Not just with him, but with my colleague's spouse is like, what the heck's going on here? Like, this is just weird.
So choosing the right trustee.
And my colleague, he's got a couple adult kids and grandkids. He would like... One of his thoughts is, I'm going to give them some money so they can buy a house.
Which is nice.
That's what his plan is. He doesn't really have anything, but that's what he wants to do. Like, I would like to be able to help my kids. And here it's been 24 months and
nothing.
One brother's, $100,000 of it. And it just got me thinking about, like, you need to pick carefully or maybe have multiple children listed as co-trustees.
So we ended up had a discussion with my 4 kids and said, what are your thoughts? And they all said, we'll do it together, all 4 of us. And I said, okay, let's talk about what issues that could create, or what issues it could create if we just choose one of you or if we choose a third party.
Yeah. And but if you haven't updated your will or trust in a number of years,
please.
No one gets out of here alive, right? We're all going to die at some point in time. We think it's going to be sometime in the future, but we never know.
Yeah.
And having these things set up ahead of time makes things a lot cleaner and simple.
Right. And Scott, let's take a couple calls. And then I want to talk about this new scam I read about in the New York Times, which...
Oh, I've got something to talk about too. Not a scam, but it just...
Is it a scam or isn't it? Let's take a couple calls and then we'll give it a discussion.
All right, let's start here with Brian in Alabama. Brian, you're with Allworth's Money Matters.
Hey, how you guys doing?
Awesome. How you doing, Brian?
Very well, thank you. I just wondered if you guys had time to let me run over a asset scenario and my goal for early
Brian,
retirement.
that's what we're doing here. We have
got nothing
in the
but
studio
time.
talking to you.
Nothing. We have set aside as much time as Brian needs.
I feel so special. Thank you.
Okay, what can we do to help?
All right. Well, I'm 53, and I'm a little definitely behind where I'd like to be. Just life happens. So I have a 401k balance currently of $350,000. The last about 5 years, I've been working on developing an income stream for post-retirement income, and I bought 4 small rental homes.
Okay.
And I own those outright.
All right. Perfect. What are they
what
generate?
Are those worth?
Pardon?
What are they worth, and how much income did they generate?
I would say it'd be hard because there's still some crazy, unrealistic numbers going around. But they're modest, small homes. So I'd say around $300,000
each, or
I bought them in 2020 and 2021. So I was actually really lucky.
I'm not familiar with Alabama, although I have visited a beautiful state, at least the parts I was in. But is it 300 each or 300 between the 4
No,
of them?
I would say a realistic value. It could be as high as 400, but I would say the 300 to 325 would be a realistic what I would walk away with.
If you sold all 4.
So, right, and I'm not interested in that.
Okay,
we're just trying to understand. We're just trying to understand.
And how much income do they, after all expenses? How much income do they derive?
After all expenses, gross before is like $4,000 a month they generate when they're all full.
Okay.
And my expenses don't run over. I do everything myself. I'm the property manager, electrician, plumber, you name it. So really, I've just got commercial insurance. Let's see, 3,700. Let's say 3,700 net.
Okay, we're going to call it three grand just to be conservative, because we're baking in some vacancy there. All right, and what else do you have?
I owe on my primary home $89,000.
Okay.
It has a value of around $325 to $350.
All right, and I assume it's a low interest rate loan.
Yeah, it's an older mortgage, so it's 5.25%.
Okay.
I'm not interested in really tapping into that. It looks like I'm going to be there for a while.
Okay.
Anyway, and I only have a small amount of debt. I owe $31,000 on my truck. I've got a vehicle payment for the first time in 7 years. I had to get something.
Are you married?
Not married, no, sir.
And what
I
is
have one son.
What's your income?
How old's your son?
My income, from 140 to 150,000 a year. My son is 12. I already have all of my homes in an irrevocable trust for him.
Okay. What's your
the
question?
Rentals and my home.
What's your question for us?
Okay. So it's a chicken or egg sort of thing. I am putting 20% into my 401k, and I'm paying extra on my mortgage, a good bit. What should I be focusing on most to get? I'm scared of leaving my job, doing the rental property full time, buying more, and having the mortgage in case something happens.
That's right. Yes, you should.
But I understand that if I buy an appreciating asset, that it could very well generate easily another $900 a month to pay the mortgage. So should I scale back my 401k to the bare 5% because my company matches 5% free money, and focus on paying off the mortgage over the next couple of years, and then the truck?
Nope.
There's different schools of thought.
Yeah.
Like
you
Dave
called
Ramsey.
us. You called us and asked us what we thought, though. So
Yes, sir.
I can't
What
speak to
would
someone.
you do?
Yes,
I would keep the 20% in your 401k.
I would keep the 20% in the 401k, and I would actually continue to buy rentals like you have. You've been able to do. Yeah, you've been able to do this over the last 4 years. You said, didn't you?
Yes.
Okay, do the same. You're doing great. If you just started this financial plan like this in the rentals over the last 4 to 5 years, you're doing great. But keep the 20% in the 401k. Your kid is how old?
12.
Okay.
12.
So look at your kid. By the time you're 59 and a half, your kid will be going into college. If you could fund part of that college education from your IRA if you have to. But this is what my guess is going to be. If your son decides to go to college, is that you will scale back on the 401k at that point in time and fund his education directly out of your income. You work till you're age 62, you continue to put 20% in and accumulate, let's say, double the houses between now and the next 9 years. You are golden. You are rich. You buy a plaid shirt, you will be a mayor of any town you want in Alabama.
I'd like to retire at 56, though, if I didn't get to that part.
All right. Well, then don't do any of that.
Yeah, sorry about that. Yeah,
No.
Quit working.
Just keep doing what you're doing. Like I just said, just keep on that path. And when you get to 56, then decide whether you have enough to retire at 56.
But should I continue to pay off the mortgage?
No.
Or should I just focus on the mortgage or focus on retirement?
I wouldn't
because
worry.
I'm out of time for it to appreciate.
I wouldn't. The mortgage is essentially what you could be.
Well, hopefully you can do both. If you think you're going to retire, I mean, you're making 140 to 150 grand a year. So
yes.
You're gonna have to be, your lifestyle's gonna have to be much less than that in the next few years in order to have any chance of retirement.
I wouldn't worry about the mortgage. So you're essentially earning at 5.25%, right?
Right.
That's what you'd be earning in a savings account around there, a little bit less than 5.25%. In a treasury bill. So it's kind of a push there. So just keep on that path that I showed you. When you get to age 56, you're doing everything you can do. When you get to age 56, then reassess whether you have enough to retire or not, or you need to make life changes.
All right.
But the path you're on is perfect. It's perfect. You got a late start. You said you got a late start. You didn't get a late start on that 401k, but you've acquired those properties. You've done well. You don't have enough money to retire. If you asked me, can you retire at 56 at your current path? The answer is no. You can't.
No. So I'll just keep trying to reinvest the rental income into another house.
That's right.
Slowly but surely. Takes about 2 years.
That's right.
That would be a good move.
5/5, then
That's
the 6th.
right.
Okay.
That's right. But
Wonderful.
What else can you do? Unless I want you, I say to okay, look, we can retire at 56. You need to live on $54,000 a year between now and the age of 56. What are you going to tell me?
Can't do it.
All right, there you go. There's our answer.
All right, let me ask you one more question, if
Sure.
I may. Let's say the 401k doesn't appreciate that much over 2 years. Probably not, a little bit. How much, if you were me, out of the 350 would you leave as an emergency, whatever? I guess what I'm saying, I'd like to buy 2 more homes, and I think I could with 200. I'll be 55 then, so I won't have the penalty. I'll just have the taxes.
That's not true.
I'll only pull it out one home at a time.
Wait. Stop. Sorry. That's not true. You have to separate from service. There's no penalty, but if you're employed, there's a penalty for 55. 55 and a 401k.
If you're planning on spending these dollars to use for a house, then don't put them in your 401k.
Yeah, but don't do that.
I wouldn't do that. You want both.
You want both. You don't keep the 20% in the 401k. And here's how you look at it. Look, Brian, forgive me for a second. Here's how you look at it. If I looked at your portfolio and how I thought about the investment thesis behind it, right, I would say, well, let's look at Brian's portfolio. So Brian can actually fix these houses. He acts as a property manager. There's value add there. Let's just call these houses, because they generate income, the bond portion of his portfolio, the fixed income portion of his portfolio, that they are designed to provide income from now until your dying day. And we're going to look at your 401k as 100% stocks, and we're going to call it the equity side of your portfolio. So right now, if I were to look at your portfolio, I would say that you're 55% bonds approximately and 45% stocks, if 100% of your 401k is in stocks. So go ahead and invest 100% of your 401k in stocks, continue that 20%, and build that real estate on the outside and pretend that's the bond portion of your portfolio.
But at best, and a good up and down, you can do 6 to 7%. Rental property, I can return 20% annually.
No, that's not true. That's just flat out not true. You have returned 20% annually, maybe because there's some appreciation on that property, but that isn't true. I mean,
they all pay for themselves in less than 5 years. It's a unique market.
Yeah, I get that, but over the long term, we're talking long term, right? You might be in an unusual position in that particular localized market, but at some point in time, every market catches up with itself, which means that if there's excess returns in any market, it actually draws capital into that marketplace, right? And because it draws capital into that marketplace, it suppresses the yields back to normal. Everything reverts to its average. Everything reverts to its means. I was talking to a guy the other day, was telling me he was buying properties in Alabama because the yields were so high. And he was buying them in Michigan as well because the yields are so high. And he was saying the same thing. It's 20%. It's 20%. Doesn't mean it's 20% forever. Right? The mere fact that you came on a radio show podcast and said, I get a 20% yield in Alabama on my rental property, people will actually start exploring whether they should be buying rental properties in Alabama, which will then suppress your yields.
Right.
That's just the way markets work, right? Capital flows to the highest yielding, lowest risk place it can. So in your particular situation, you don't want to, just because in the short period of time you've invested in these, you've got 20%, doesn't mean they're going to be 20%. Heck, if I thought I could get 20% forever, I wouldn't have anything else anywhere but in that marketplace. Me personally, I would move to Alabama today.
If I can get 20%, I'd liquidate everything I've got.
Everything I own. But 3 years doesn't make a lifetime. 4 years. So what you're doing for diversification.
Rent is not decreasing anytime soon.
Okay, talk yourself into whatever you want. I'm just telling you how economics work.
Right. Oh, I understand what you're saying. It's just, okay. I was just thinking that as old as I am, I can't expect
you're 53.
Another bull,
You're 53.
You can't expect another bull.
bear
not
market.
having access to money.
You're okay. You just do what like I said. You call for our advice. I'm not going to change it because you want to create some sort of positive cognitive bias in your investments. That's what it is. It's a positive cognitive. We all do it. We all talk ourselves into
it's been
whatever.
very rewarding.
Oh, of course it has. I
Right.
have had investments that have been so fabulous. I can't even talk about them.
Right.
And then
until it isn't, right?
yeah, look, it's fun until it's not. But
Yes.
look, in a diversified portfolio, the reason you have diversification is because you don't know what's going to happen. We have no idea.
Exactly.
As I tell my kids, I have 4 children, and they're like, "Dad, what's the best investment you've ever made?" You know what I say to them? You're asking the wrong question. The question you should be asking is, what's the worst investment you've ever made and why?
It's having you punks.
And I say to him, and the reason is because you, as my children, will learn more from my mistakes than you will from my successes. I, as an investor, will learn more from my own mistakes than I will from my successes because the loss of money is much more difficult. That's why you've got to just own it. We don't know. We're going to keep it diversified. In fact, the mere fact that you tell me that these rentals have done 20% actually scares me. It means that they're going to revert to their means faster because they're so far out of average. So,
Or just not have an appreciation for a period of time.
That's
Things
right.
don't go straight up.
yeah. So
Anyway,
anyway,
that's our opinion.
appreciate the call.
Thanks, Brian. Let's continue on talking with Dave. Dave, you're with Allworth's Money Matters.
Hello. I have a question about cryptocurrencies. I was just wondering what you think about adding a small portion to a balanced portfolio, maybe like Bitcoin and some XRP or something. What do you think about that?
When you say small, what percentage?
I'm thinking like $500 at the most.
Out of how much?
I've got like retirement,
Like $1 million?
401k, and yeah, I've
Sure.
probably about $1 million. Yeah.
Yeah, I'd go more than 500.
Yeah. Okay.
If I were going to go with,
What do you mean you'd go more than 500?
it's not exciting enough. 500 out of $1 million. I mean, if you're going to play
Okay.
in,
to your
if you're
point,
going to
Pat,
play in
To
it.
Pat's point, it's a speculative thing you're doing, right? Probably a bit at this point. You feel like you're missing out. Everyone's been talking about this. You don't have any. You want to have a little stake in it or something, right?
Yeah. Exactly.
But like I quit. Not that I ever gambled much, but when I was younger, every once in a while I'd go to Tahoe or somewhere and I'd play blackjack, maybe once a year. And I used to bet $20 or whatever. If I lost $100 when I was in college, it meant something.
You felt it.
Yes. And now I've discovered that I don't want to actually gamble enough to where it would impact my life at all. So there's no excitement in it. And I just basically said I'm not going to bother playing anymore.
I
So
feel like it's a waste of time.
a waste of time, and it's not enough. It's not. Anyway.
Yes. So but look, I wouldn't do it just because I don't understand it. I gotta flat out I think it's hype and mania. I had a conversation with a gentleman that is a longtime listener of this show and a client of the firm, has been for years, who thought we were completely missing the boat, and I might be. And but if you want to play in the sandbox, kick some sand around, have at it.
I mean, it wouldn't surprise me, Pat, if Bitcoin 2 years from now is worth $250,000 or $2,000.
Either one. Yeah, and what really perplexes
Either one are within the realm of possibility.
and there are some risks to the crypto. The word crypto means it's right. You can't break the chain. That someone it's written in stone, right? What happens if someone is able to hack that? People say, "Well, it can't be done." Well, okay. Right?
Okay. Yeah.
I mean,
any sort of investment. If you're talking about like people invest for a variety of reasons. Obviously, the number one reason is for some financial security, investing for their future. But people also like to dabble in other things, and it's not uncommon. I mean, look, we've got clients that we manage the 95% of their portfolio, and then they have a little side account, sometimes with us, sometimes not, and they go and pick different stocks and do different strategies, and they just enjoy doing that. They find some sort of satisfaction. They also realize that they don't want to have the vast majority of their money there because they can't afford to lose the vast majority of the money.
If Dave, if you said I've got $10,000 and I'm going to buy, what did you say, XPR or whatever?
XRP.
I don't know what XRP is. What is XRP?
Oh, it's a real hot one right now that they're all promoting.
Well, if I was to buy one, I might buy one that's not real hot. Buy the one they're about to promote.
That's it.
Okay. All right.
Buy the Doge.
Is the Doge?
Is that still around?
I don't know.
There's over 10,000 plus cryptocurrencies right now.
Mm-hmm. Yeah.
Over 10,000.
Okay.
Yeah, I appreciate the call, Dave. And for some aspect, it's just a transfer of wealth from
promoters, from non-promoters to promoters.
Yes. Don't you think?
Yeah, I think Bitcoin lives in a different realm.
It does. But some little coin that's hot now that...
Yes. Yeah, the Melania coin, the Trump coin, the meme coin.
I've seen the headlines. I've not read any of the articles about the
I have
coins.
read a couple. I'm like, hey, nothing surprised me. Right?
Yeah.
Didn't you have a neighbor that came out with a cryptocurrency at one point in time?
Yeah. I haven't looked at it in a couple of years.
You're going to come out with a Scott coin? So a picture of you on the coin?
No,
they're not really coins.
They wanted to know if I wanted to help launch this thing a few years ago.
Oh, by promoting it?
Yeah, I'm like, I'm not going to promote it.
All right. So, you tell me your story first. Your scheme.
Well, so this is actually an article in the Wall Street Journal that I read. And I don't know how I was surprised by it, but I was surprised by it. And to give you some little context here, I remember years ago, Berkshire Hathaway was the company founded by Warren Buffett, of course, and he chose to never split his shares. So as the value of the company increased, the share price got more and more expensive, and to the point where it was out of reach for the average Americans. And there was a mutual fund, this was a long time ago, Pat, that created a mutual fund where you can buy in the mutual fund. The mutual fund owned one security, it was Berkshire Hathaway stock. And then they would charge a management fee for that.
On top of it, just so that people could buy smaller denominations.
And so when Warren Buffett finally got wind of what was happening, that someone's making money on his stock, they issued the Class B shares, which is essentially, I think it was just to take the share price, divide it by 100, and that's what the baby Bs are. And so the average American could then afford it, and it killed the management fee of this mutual fund. So yes, is it a scam or not a scam? I think it depends on your perception here. But this has to do with privately held companies.
So what is a privately held company?
One that's not public. And in particular, this particular article pointed out SpaceX. SpaceX, founded and controlled by Elon Musk, who controls Tesla, the Boring Company.
NASA,
he controls NASA. Doge. The entire government. Anyway, so, but it's privately held. And companies these days, companies don't like going public because when they go public, they have to go through all kinds of public disclosures. But if they keep their shareholders limited to under 2,000 holders of records, they can remain a private company. So what has transpired is there's these investment pools, so to speak, that are being formed where investors invest in these and then they go out and buy SpaceX stock in the secondary market, right?
And who do they buy it from? SpaceX employees or previous employees of SpaceX that have over-concentrated positions in this relative to their net worth and want some diversification.
Right. So if you're an executive at SpaceX, you've been there forever, and suddenly your stock's worth
$200 million,
$20 million, whatever, and your net worth is relatively
the same
or nothing, right? Like you'd like, well, I would certainly like to
Get some
diversify and maybe spend some of these dollars if you've been there. So that's what creates a market for it. But they're limited to 2,000 holders of record. So enter these special purpose vehicles, SPVs, where
not to be confused with the SPACs.
That's correct.
Special purpose acquisition companies.
SPVs. The management fee on these, the ones that were highlighted here, it's similar to a hedge fund. So they're charging a 1% management fee, then 20% of the profits above, I think it's 8%. 1 in 20 structure.
Wow. For doing nothing.
Pooling these things together to buy one company.
Yeah. Crazy. Do they have to get the blessings of Elon?
Well, that's the article talked about was Elon's friends doing it. A side hustle for friends of Musk was what the headline of the article was.
Wow. That's rich.
And this is all allegedly based on the Wall Street Journal's reporting. So I'm not going to.
We are relying on the Wall Street Journal for this.
But it's it just got me thinking, like, the value is bid up
already.
And it's incredible market cap already.
Yeah, already. And then on top of it, someone is actually taking a big cut. And I'm sure there's a huge market for it.
Well, I'm sure there is.
Massive market.
But it's also one of these ways that we're escaping, like there's the letter, the intent of the law, and there's the letter of the law. And all you have to follow is the letter of the law.
Not the intent.
So the intent is, look, if you're going to have more than 2,000 holders of record, we want you to be public, and you start having these.
But since we create a company as the holder of record, we really don't know who holds this.
That's right. So there could be tens of thousands of shares.
I don't know if mine's nearly as good, and I'll just give it a quick shout out here for this. What I found fascinating is that a number of weeks ago, there was a 60 Minutes piece on different types of scotch and bourbons being made, and the barrels and how they're aged. And on that, they actually interviewed a company that invests in what are new or fresh barrels filled with liquor, right? Essentially moonshine, and it gets its flavor from that. And this was a 60 Minutes piece, and the guy was talking about what a great investment it was. And I thought, wow.
In the barrels?
Well, they're filled. So then you and I would go out and buy, let's say, 10 barrels that are filled, and then we would pay to warehouse them for 8 years, 10 years, 12 years, and then we would take them and sell them into the secondary
They do
market.
the same thing in the wine market.
Exactly the same thing, except now this thing is just...
I've never had any interest investing in any of that stuff. But anyway, tell me what
it's filled with scams, which is you would expect, which is people are buying these barrels and thinking they're stored somewhere. And in fact, they did buy them. So did 8 other people buy the same barrel. Right? And so anytime that you see these things that are hot and new investments, you just look at it and you think.
And they might be they're probably advertising in social media, maybe even on the radio, maybe even on television.
Yes, especially after this 60 Minutes piece that came out a few weeks ago. And I just thought to myself, when I watched it on 60 Minutes, and this came out a couple of weeks later.
Funny. You watched the 60 Minutes like, that looks like one of those areas there's going to be scammers coming in.
It's going to, it just seems a little bit like.
I mean, how do you do your due diligence on something like that?
I don't know. Remember there was a scam in the Sacramento area, Scott, when we first got into business 30 years ago? The guy was selling cattle.
But they didn't exist.
That didn't exist.
Yeah. Right. Yeah.
Well, careful.
You're going to be careful. All right. Like we talked about at the beginning of the program, Mark Schoen is going to join us. Mark, thanks for taking some time.
Yeah, absolutely. It's good to be here. How you doing, Scott?
Good. And Mark is one of our certified financial planners in
San Francisco Bay Area.
The Bay Area.
But a lot
some
of
in Sacramento.
But he said
Nevada.
Like most of your stuff you said you do remotely now, correct?
I do. Yeah. Most of it is remote, but there's still some in-person things. But yeah, it's probably 90% remote.
Wow.
Well, it's interesting how I think the pandemic changed a lot of our behaviors, mine included.
Yes.
And there's you think about long-term clients that would come in periodically for whatever the reviews are, and then now it's like, I think I'm good. Why don't we just do this? I mean, if I can go to the dentist remotely, I'd certainly choose that rather than driving all the way across town to see my dentist. And that's the same thing. Number one. Number two, just with we've got experts, a variety of different expertise that are in different parts of the country, all over the place.
Yeah, and they drop into meetings all the time.
Yes, and so if maybe a client's in the office with an advisor and we have a big monitor behind, that person pops in, or it's all remote.
Yes,
and that's not sometimes.
Yeah,
smart.
I mean, it's a better client experience. Think about it. They hop in their car, drive 30 minutes to come to see you, spend an hour there, drive it's a 2-hour event that can be handled efficiently in an hour.
Yeah. Well, not only that, if you want a portfolio specialist, they can pop in the meeting briefly, or an attorney, or a CPA, or insurance expert.
Anyway, Mark, you have a story for us. Is this correct?
Yeah, I have a story and just some tactics more around some things that you can do within when you get market volatilities like we see today.
And before you tell this, I got to tell you that you were on the show a while ago and you talked about Silicon Valley Bank and how you had put these collar around executives so that they were protected from a downside. And I've thought about that about 3 or 4 times, and how hard it is for a client to do that with a stock that's doing so well, right?
And think of it like insurance. There's a cost. You pay a premium for those guarantees,
right? How hard it is for that particular client. But then after they live through it, and the person in the next office didn't do those techniques and changed their life irrevocably forever.
Yeah.
Right.
It's
it's chilling.
Not only premiums. Yeah. Not only premiums, but sometimes it's actual tax that you have to pay. I mean, there are some pain points, and it's against a stock that you are generally pretty excited about, as created your lifestyle, all the things. There's all kinds of emotions around it as well. So.
Yeah, and you only do it with stocks that are doing really well.
That's correct.
That's one of the only ones that you have a constant
position.
Have
that problem,
right? So anyway, I want to thank you for that last conversation, because I have thought about it. In fact, I thought about it this morning driving into the show. I have thought about it no less than 3 times about just how actually, like, at the end of it.
That's why it's important for people to step back and say, what are they really trying to accomplish in their life? And most people get to a point where they're more concerned about not going broke than they are about becoming wealthier. And we get confused because we get excited.
Well, you spend money, not returns, is something that I often say to clients, right? So if you're not worried about headed to the cocktail party and my portfolio did X and yours only did Y, you spend money. It's capital. It supports your lifestyle. So you just have to think about it a little in a more broad sense. And you have to have the passion to get your clients to do the right thing. I mean, if you didn't have conviction and they didn't have the courage, we're having extremely different, conversations today than we had. So, it's important stuff. So that helps to kind of live through some of those things.
I mean, it's interesting. Like we've had communications training with our advisors. I mean, like sometimes the best people with numbers are not always the ones that are also the most outgoing and connecting well with people, right? And so part of the interesting about this profession, it's the people that can do both, that are both good with numbers and highly interactive with people. And to your point, Mark, it's you've got to have the conviction, and then you need to be powerful. You need to be skilled enough to help guide that client down the journey to where they end up with that conviction.
Yeah, and they're thankful for it. So your techniques today, you're going to share a couple with us.
I wanted to talk about just a client that I have that when we saw market correction, what kind of things do we do? And there's essentially three main things that can happen. One broad case thing, but first of all, the work that we've done in advance of this correction allows us and gives us the opportunity to do the things that are important. So we talked a little bit about direct indexing. You've talked about it on the show here, and and that's the ability to tax loss harvest. Even when markets are going up, you have the ability to do that. Well, that puts you in a position to do some things that are as simple as rebalancing a portfolio when markets start to get very volatile, and to rebalance a portfolio without causing any taxation. So the decisions that you make and the planning work that you do years in advance help you be more proactive in an environment like this. So the first thing is just allowed to do rebalancing without taxation.
And that's
was the biggest thing.
And Mark, that's just because you've got loss carry forward that you've actually just kept dry?
That's correct.
Right?
That's correct.
Or rebalance in retirement accounts.
Or rebalance in a retirement account. Yeah, correct.
And maybe trying to look at the overall portfolio, let's say you got half your assets in taxable, half in retirement accounts, you might actually end up tweaking it a bit where you do a further rebalance in the retirement account and a little in the taxables to avoid triggering a tax bill.
To get to the target state of the portfolio.
That's correct. That's correct. And I do have some clients that, we harvest these losses, and you could do this while the market is trending up. So most people think, thinking, wow, why are we creating a bunch of losses? It's something that you can do while the market is appreciating.
Well, you're doing it because you're smart.
Yeah, it's helpful. And then they're like, should we use some of those losses? I've always getting asked, should we use some of these losses this year? I said, we're going to utilize the losses when there's a purpose. And that purpose is going to be to rebalance, to take cash out to do something. So you just want to be thoughtful about that. And
there's no time limit. We can carry forward realized losses indefinitely. Except to our grade.
You can't. But you don't really need them to your grave because they step up in basis.
Whatever.
That's correct. Yeah. Well, you also don't want to carry losses into your grave as well because you get a step down in basis. So yeah. That's right.
That's just so bad.
That was really bad.
That was bad.
Nice try.
But the other thing that you could do is in these environments is sometimes it's a good time that if you have things that have held up pretty well in this environment, you'll do charitable giving with appreciated stock. So those are some of the things either to reduce and get your portfolio back in balance. So growth stocks have done really well over a really, really long period of time. They've started to correct a little bit harder. But if we're going to be doing charitable things, instead of selling to rebalance, we'll use charitable giving to gift away those highly appreciated positions.
Did it last week. After the conversation, the exact conversation was, now is a good time to do this. And by the way, not only are you doing it because, we're going to do a lump sum, that rather than every year, let's do it every 3 or 4 years so that we actually get as much benefit out of it as possible. And the other is just for the record keeping, bookkeeping, the ease of actually gifting to charities, a donor advised
fund
makes it so easy.
Yeah. And you would, in this type of environment, because there's a rebalancing benefit, you would be more likely to do, or, in this case, it was more beneficial to donate the appreciated stock directly instead of using charitable remainder distributions or those kind of things, right? And kind of wait till the end of the year and do that. So
explain that
is a bigger thing.
Explain that to you. You would just choose the charity and give
instead of using, if you have a set amount that you're going to give, a lot of times year over year, it makes sense to use a charitable distribution, qualified charitable distribution out of your IRA.
Correct.
So
if you're over 70,
and away you go. Yes, over 70 and a half, you can do it. Yeah. Right. Got it. But in a year like this, I'm saying let's avoid future capital gain on a position and it benefits your portfolio long term by taking some of that out of the portfolio. So,
well, Mark, as always, appreciate you taking some time to be with us. Mark Schoen, a CFP extraordinaire.
And Mark, how's the band going?
Is going well. We played after the last time I was on with you.
Yes.
All was well. Our hits on YouTube went way up. I will tell you that.
Don't get too famous out there. You're going to end up quitting all work.
Wait, stop.
You're a rock star.
Stop.
At sick. How old are you? 59?
59, yeah.
Mark,
59, you're a rock star.
Stop for a minute.
There's a real big, heavy demand for 59-year-old drummers.
When you said the hits on YouTube went way up, like they doubled, so now you got 10?
Oh, no, 17.
That's funny. That's funny.
Thanks, Mark. Thanks, Mark. Appreciate it. We're about out of time here. Hey, I want to let everyone know that this Tuesday, Pat and I are going to be in studio taking calls. Tuesday, May 20th, this Tuesday, from 10:30 to 12:30 Pacific time. 10:30 to 12:30 this Tuesday, Pacific time. If you want to be part of the program, send us an email, questions@moneymatters.com, questions@moneymatters.com, or you can call 833-99-WORTH. We'll see you again next week. This has been Scott Hansen and Pat McClain of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.